Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Government and Central Bank Responses. Government and central bank responses to economic crises are critical in shaping the trajectory of an economy's recovery and long-term health. These responses typically involve a combination of fiscal and monetary policies aimed at stabilizing financial markets, restoring economic growth, and mitigating the adverse effects of the crisis on households and businesses. Fiscal policy, managed by the government, involves adjustments in government spending and taxation. During an economic downturn, governments often implement expansionary fiscal policies to stimulate demand. This can include increasing public spending on infrastructure projects, social programs, and direct financial assistance to individuals and businesses. Such measures are designed to boost aggregate demand, create jobs, and stimulate economic activity. For example, during the Great Recession of 2008 to 2009, the U.S. government enacted the American Recovery and Reinvestment Act of 2009, which included $831 billion in stimulus spending aimed at jump-starting the economy. Tax cuts are another tool used in fiscal policy to increase disposable income for households and reduce the tax burden on businesses, thereby encouraging consumption and investment. However, the effectiveness of tax cuts can vary depending on the economic context and the specific design of the tax policy. For instance, tax cuts targeted at low and middle-income households are generally more effective in stimulating demand than those aimed at high-income households, as the former are more likely to spend additional income on consumption. Monetary policy, managed by the central bank, involves the regulation of money supply and interest rates to influence economic activity. During a crisis, central banks typically implement expansionary monetary policies to lower interest rates and increase liquidity in the financial system. By reducing the cost of borrowing, lower interest rates encourage businesses to invest and consumers to spend, thus supporting economic growth. The Federal Reserve, for example, responded to the Great Recession by cutting the federal funds rate to near zero and implementing unconventional monetary policies such as quantitative easing. QE involves the purchase of long-term securities by the central bank to inject money directly into the economy, lower long-term interest rates, and support asset prices. Another crucial aspect of monetary policy during crises is ensuring financial stability. Central banks often act as lenders of last resort by providing emergency liquidity to financial institutions facing short-term funding pressures. This helps prevent the collapse of banks and other financial institutions, which can exacerbate the economic downturn. During the 2008 financial crisis, the Federal Reserve established several emergency lending facilities to provide liquidity to key financial markets and institutions, thereby stabilizing the financial system. Both fiscal and monetary policies have limitations and potential drawbacks. Expansionary fiscal policy can lead to higher budget deficits and increased public debt, raising concerns about long-term fiscal sustainability. High levels of public debt can constrain future fiscal policy options and potentially lead to higher interest rates if investors demand a risk premium for holding government bonds. Similarly, prolonged periods of low interest rates and unconventional monetary policies can create distortions in financial markets, such as asset price bubbles and excessive risk-taking by investors. International cooperation and coordination are also crucial during global economic crises. Crises often have cross-border spillover effects, and coordinated responses can help mitigate these effects and support global economic stability. For instance, during the 2008 financial crisis, the G20 countries coordinated their fiscal and monetary responses to restore confidence in the global financial system and stimulate economic growth. Similarly, during the COVID-19 pandemic, international financial institutions, such as the International Monetary Fund and the World Bank, provided financial assistance and support to countries facing severe economic disruptions. The effectiveness of government and central bank responses to economic crises depends on various factors, including the nature and severity of the crisis, the existing economic conditions, and the design and implementation of the policy measures. Policymakers must carefully assess these factors and adjust their responses accordingly to achieve the desired outcomes. Additionally, transparency and clear communication are essential for maintaining public confidence and ensuring the credibility of the policy measures. In conclusion, government and central bank responses to economic crises involve a combination of fiscal and monetary policies aimed at stabilizing financial markets, restoring economic growth, and mitigating the adverse effects of the crisis. While each policy has its limitations and potential drawbacks, coordination between fiscal and monetary policies, as well as international cooperation, is essential for an effective response. The experiences from past crises, such as the Great Recession and the COVID-19 pandemic, highlight the importance of timely and well-designed policy measures in supporting economic recovery and ensuring long-term economic stability. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.